Hello, thank you for joining us. Welcome back to our webinar and office hours series. This month, we're going to do an introduction to income tax planning. So let's start off with an icebreaker. The US tax code is so long that if you were to read it at 1 page per minute, it would take you 30 days straight. So this is an interesting context for the US tax code, meaning if you just do 8-hour days at a minute a page, it'll only take you 90 days to read the whole thing. Some very boring days, perhaps, but today we're just going to skim the surface of the tax code and make sure everyone has a good understanding of income tax. So here's our agenda today. We're going to first answer the question, what is income tax? And we're going to review the fundamentals, different types of income, the tax formula, some examples of the tax formula in action, the tax brackets that are involved, and then we're going to touch on some tax law topics. So this is penalties, statutes of limitations, and then I will demo my specialty tax planning tool, Holistiplan, for you, everyone. And we'll end with our 20% summary. So what is income tax? Well, income tax is something levied by the federal government or a state government. And it's what it says. It's a tax on income. So income of many types, broadly conceived, anything where you have a gain or your situation has improved is considered an income. You can see here on this graph that income taxes are the largest portion of taxes. So they are a large part of what funds the federal government day to day. So let's break down some fundamentals. There are 3 different types of income broadly. First, active, passive, and capital or portfolio income. Let's start with active income. This is what most people think of as income. It's coming from your employer, or if you're self-employed, then from your own activities. Passive income is income that you receive where you don't have that material participation. So when you're actively employed, you're a material participant. There's a 500-hour annual threshold that you have to cross in order to be a material participant. And under that threshold, all income that you receive from activities where you're not a material participant is considered passive income. So this is commonly seen in rental income or maybe a business partnership where you have a stake in the business, but you're not necessarily putting your time in, you're not an active participant. And it's important what these different sources of income are classified as, because they're only able to offset themselves. So if I have a loss in my business, it's an active loss. I'm able to then offset other sources of active income with that loss. But if it's passive income, I can't use that active loss to offset the passive income. It would have to be a passive loss instead. So the third type is portfolio income. This is income coming from asset sales. So this can be stock sale, it can be from a house, maybe a business or a piece of machinery. There's a more favorable capital gains rate applied to this type of income. It's on a scale from 0 to 20%. This is the long-term capital gains rate, long-term being 366 days or more. Most people will find themselves in that 15% capital gains bracket. So short-term capital gains are taxed at ordinary income rates, all the way up to 37%. These are all gains from sales that have been held less than a year. So short-term, less than a year, long-term, over a year. It's important to understand that capital losses, let's say from a house, you sell your house and you sold it for less than what you bought it from. So you have $10,000 of loss that you've recognized. You can use 3,000 of that loss every year moving into the future against your active income. So this is one exception to that rule where we can only use income to offset the same type of income. If you have a capital loss, you're able to offset $3,000 per year and then also carry that into the future if there's any remaining loss. So let's break it down in an example. So we have Alex. Alex has the following income and losses for this year. $50,000 from a job, $10,000 from rental property, $8,000 capital gains, $12,000 capital loss, $15,000 passive loss. So how does this shake out for Alex in the end? Well, these are the results here. We see $47,000 in active income, $5,000 in passive losses, and a $1,000 capital loss to be carried forward. Both the passive and capital losses carry forward to future years. So let's break down that passive loss. We have $10,000 of passive income from a rental property and $15,000 of a passive loss from a different rental property. So if we net those out, we have a $5,000 loss. It's a passive loss, and we don't have any other passive gain to offset it. And so therefore, we're just going to have to carry that loss forward. And hopefully in future years, we have a passive gain and use this loss to offset it. The capital loss is similar in that way, but it came about a little bit differently. So we have an $8,000 gain and a $12,000 loss from portfolio income. Net, there is a $4,000 loss. $3,000 of that is able to be applied to our active income. And that's what's lowered our active income to $47,000 for Alex. And then that remaining $1,000 of capital loss is able to be carried forward into the future. So now what? We've decided what our income is. How do we figure out what taxes do? So reuse the tax formula. You might be thinking, oh man, like this is why I hate taxes. They're complicated. And yeah, there's complexity to them. But this formula is pretty straightforward, only a couple steps. And if you can grasp this, you grasp at least half of the income tax basics. So here's our example. Alex, he has $47,000 of active income. You can see that on the top line there. He has two different types of adjustments to solve for that AGI. He has some student loan interest that he's paid throughout the year. So that's an adjustment. He's able to deduct that above the line. And he's also made HSA contributions. So those contributions are able to be taken as a deduction or adjustment and reduces gross income to solve for his adjusted gross income. His adjusted gross income is $44,800. And after that, he's able to take the standard deduction, $15,000 for 2025, because he's single, he's filing single. After that deduction, we see he has $29,800 of taxable income. If we apply that to the tax bracket, we can see that Alex owes $3,337.50. Here are the tax brackets involved. We can see that they start off at lower rates, 10%, and go all the way up to 37%. So the first dollar you earn is going to be at that 10% rate. But as you earn more and more money, you move into these higher tax brackets. So it comes to a point, let's say you're single and you earn $150,000 a year. You're going to be paying 24% on that last about $45,000, maybe a little more. Whereas all the money you've earned between $48,000 and $103,000, that will be taxed at 22%. And the bracket before that, 12%, 10%, because they've been filled up all the way. It's just the marginal bracket that you've reached is that 24%. And here's an illustration of that. We can see our friend Alex. He has $29,800 of income this year, and he's completely filled up this first 10% bracket, 100% of the way. He has then additional income, which is taxed at the next bracket, 12%. So he's filled up that bracket 48.9% of the way. So his total tax from that is that $3,337.50. His effective rate, and this is a blended rate of those two, is 11.2%. And his marginal tax rate, this is the tax rate at the edge, the last dollar that he earns, next dollar, would be taxed at that 12% marginal rate. And don't forget about state income tax. We're not going to touch on that today because state income tax varies so much. Each state has its own laws and regulations. So definitely reach out to someone local if you're interested in learning more about your state income tax laws. All right, next section, tax law. Let's jump into it with penalties. So there are two major types of penalties: failure to file and failure to pay. So failure to pay, pretty straightforward. You have taxes that you were supposed to pay, but they went unpaid. So for every month or part of month that they remain unpaid, there is a 0.5% penalty applied. So this is in addition to what is already owed. And it's similar with failure to file, except instead of 0.5%, it's 5% of the unpaid taxes is a penalty each month accruing or part of a month. And there are exceptions to this. So if the return is filed greater than 60 days late, there's a minimum payment that's due. It's the lesser of $485 or 100% of the unpaid tax. The failure to file payment is also reduced by the failure to pay penalty. So if they overlap. So if the same month you both have a failure to pay and a failure to file penalty applied, then the failure to file is reduced by the failure to pay amount. So both of these penalties will max at 25% of the unpaid tax. But why would you want to pay a penalty when you don't have to? And we'll get into that in the next slide. So there's no example for this because all examples are bad examples. You don't want to pay any tax penalties. It's simply an expense and you don't get any benefit from it. The most important things that you can do to avoid tax penalties is number one, file your tax return on time. Even if you're not sure of all the numbers or there's still questions remaining about, let's say you have some outstanding K1s or something like that, you can always file an extension. Filing an extension is a great option if you know you're not going to meet that tax deadline. But you can also file your tax return and then amend it later if you need to. But by filing that tax return initially, you're then avoiding those tax penalties later on down the line. And then number two is pay your taxes as you earn your income. So if you're a W-2 employee, you have withholdings from your wages. You'll see that on your pay stub every week or month. And the withholding that you pay is for taxes. So as you earn that income, each paycheck, you have some put away for taxes. If you're self-employed, you don't have that W-2 withholding option. And so you have to make estimated payments quarterly, just based on what you think your income is going to be for the year. Because we have a pay-as-you-earn system for income taxes in this country. So as you earn that money, you're meant to pay on it pretty quickly. So why does it matter? Why do we want to do these things? Why can't we just pay the penalties, and what's the worst that could happen? So other than increasing expenses unnecessarily and not being able to use your hard-earned money to maximize on your own goals, you'll need to give that to the IRS, and that's not ideal. But the IRS also has a lot of powers. They're very powerful. All the resources of the federal government. They're able to seize property, garnish wages, and can even put people in jail through criminal prosecution. So best to stay on the good side of the IRS and just file taxes, doing your best the whole way through. So statutes of limitations on these penalties, the IRS can't come back indefinitely and say, you owe us this money. Eventually, you have a statute of limitation that prevents them from collecting additional penalties or taxes and interest. That first statute of limitation is on 3 years. That's the general statute of limitation, where unless there's fraud or gross misstatement, 3 years is the general line where the IRS is not able to assess any additional taxes, penalties, or interest. The next statute of limitation is extended to 6 years. And this is if the IRS finds you omitted more than 25% of your gross income on your return. Then beyond that there's no statute of limitation if you file a fraudulent return, making false statements or attempting to evade taxes. Then also if no return is ever filed. So some people think, well, if I never file a return, the IRS can't come after me and tell me I did something wrong. Well, the IRS can come after you and say you owe these taxes. They can assess you for taxes and penalties and interest. So because that return was never filed, statute of limitation clocks never started. Something 20 years ago, if I file the return today, I'm going to start that 3-year clock today. Whereas if you never file it, the 3-year clock will never begin. The IRS can come to assess tax tax bill at any point. Okay, so let's check out my specialty tax planning software, Holistiplan. This will be fun. So here we have Holistiplan. This is one of the tools that I use when I am creating financial plans for my clients. So here we have a demo account, Austin and Lilia Accumulator. So how it would work is I ask the client, Austin and Lilia Accumulator, for their tax returns. I send them a secure upload link. This company is SOC 2 compliant, very secure. I do my own due diligence on any vendors that I use that hold client data. So I create a link for them and I select the year of the tax return. They upload it, and then through machine vision, it's digitized, and the important information, the tax information, is extracted in a much more readable fashion. So instead of going cross-eyed trying to figure out what's important on the return itself, it just breaks it out line by line and puts it in a simple 2-column table. Okay. So let's see if we have a report. So this report provides a lot of interesting data visualizations. First, we have key figures that have been taken out, total income, AGI, deductions, like everything we were just talking about, right? Solving for the taxable income. Look, their gross income was $66,100, but their taxable income is only $28,800 because they have these deductions involved. We see their marginal bracket. So the next dollar that they earn would be taxed at 12%. They're claiming some tax credits. But let me show you more of the visualizations here so we can see. So just like we were breaking down the brackets beforehand, this is that same thing, just vertically instead of horizontally. So they filled up the 10% bracket, and now they're starting to fill that 12% bracket. Some Schedule B income, okay, taxable versus tax-exempt interest. This is important for when you're deciding what types of bonds to buy, perhaps. And then here we have an MAGI table for other planning considerations. So as incomes increase, you start to phase out of the ability to make contributions to certain accounts or phase out of certain tax credits. Let's find an example here. So the American Opportunity Credit. So this is for educational purchases. We can look 4 years, all right, first 4 years of college, maximum annual credit, $2,500 per eligible student. Okay. But there's a phase out. So if you earn less than $160,000 a year as a household, you can earn this credit, totally fine. Over this 180,000 mark, and you will get $0 from this credit. And in between, there's a phase out range where you have to figure out how far am I through this phase out range? And then that ratio is applied to the credit to solve for your credit in that case. Let's see, you can see there's MAGI, which has a bunch of different definitions. And we were talking about how if you read a page a minute every day for 30 days, you can read the whole tax code. But this is why I use this tax planning software, is because they've built it all already. They have a very good tax engine that they just feed information to, and then it shows what's most important. And you, along with your planner, can decide how to reach your goals. So they've made a contribution to an IRA, and then they've taken the standard deduction, and they have some tax credits that they're taking. Yep. Okay. So what else can it do? One more thing. I'll just show you. This is the scenario analysis portion. So what we've been doing so far is just breaking down what's already happened, right? This allows us to then project and plan into the future. So 2 things happened between tax year 2022 and, let's say, it's 2023 now. Okay. So someone went back to work. One of them went back to work. Okay. So their income increased, and they had another kid. So their income increased, and, just increasing it here, there's a lot of trickle down effects that it has throughout the forms. So we just increase this number, and we see the engine increases the AGI. Taxable income also increased. Deductions, other taxes. Let's see, where's that additional kid? Dependents. Additional kid here. You can see taxpayer 1 is blind. So this program gets very detailed. Being blind will affect Social Security payments predominantly. Okay. And you can see that with that increased income, that they also have an increased number of dependents. but their total tax is going to increase because they got a refund last year. This year, they're gonna owe some taxes. And that's okay. This program allows them to plan for that. And maybe they say, we don't really have that right now. Is there any way that we can reduce that? Let's see if we can find one real quick. So, I mean, number one would be to make less money, but we don't really want them to do that. So let's see, qualified IRA distributions. We want deductions, Schedule 1 deductions. There we go. So they are teachers. So we're going to give them, say they spent $500 between them on educator expenses, and they did have an HSA. So we make the recommendation to them to increase, if this fits with their goals, of course, to increase their HSA contribution to $4,000. Okay. Self-employed tax, self-employment area deduction. And we're going to increase their IRA deduction here. Okay, let's find that applicable amount. We're just going to increase it slightly. Okay. You can see with these changes, the total tax bill has been reduced. So we've saved them about $1,000 and they've saved more into their retirement accounts. So win-win if this lines up with their goals. So yeah, that's Holistiplan. Very powerful, allows very detailed, fine-grained changes to a tax scenario so that we can project and plan into the future. All right, so we almost made it. Here's the 20% summary. Income tax is calculated in various types of income: active, passive, and portfolio income. Active income is what most people think of as income. Passive income comes predominantly from rental properties or business partnerships. And then portfolio income is also capital gains income and has a different bracket than active or ordinary income. We went over the tax formula. Here it is recreated. There are many tax calculators online. You can find those, or you can talk to someone like me where we can help to plan your taxes. We went over the different tax brackets themselves, showed some examples about how Alex solved for his income, how his income was applied to the tax brackets. And we went over the different penalties and statutes of limitations that exist if taxes aren't filed and paid in a timely manner. There's also state taxes. Don't forget about state taxes. We didn't cover them today, but they are important. And then we went over Holistiplan. One of my favorite tools that I have, provides a lot of value to my clients. Thank you for joining me today. My name is Thomas, as always. Longitude Financial Planning is my company. Thanks again. Come on back next month.